So why should one invest in unlisted market, right? The reason is that if there are maybe 2,000 companies which are there on the public market side, or maybe actually 500 to 1,000 which are actively traded, the universe on the unlisted side is much, much larger. For every one stock which is listed, you've got 3 stocks which are unlisted. So if you've got 1,000 stocks which are worth investing on the public market side, there are 3,000 companies on the unlisted side which are worth investing. So the universe of investment is that much larger if you're exploring the unlisted side. And in a public market, you will buy whatever price you're getting at the counter. If HDFC Bank is at a certain price, it is at a certain price. You don't have any say. You want to buy, you buy. You don't want to buy, leave it. But in the unlisted market, you, like I mentioned, you sit across the founder or the company management and dictate the terms of investment. So we will say that, we want to pay 10 rupees, we don't want to pay 12 rupees. So that is a negotiation or the power of negotiation which helps lower the entry valuation. We can decide the price at which we go in, a liberty which a public fund manager will not have. Similarly, coming out also, whenever we decide that an IPO has to happen, like today there is a company called Indegene which has come out with an IPO. I'll just take you 2 slides back. So this is a company which we had invested into. Today, I think the company they are quoting at a massive grey premium. The IPO price is 450, but I think they're going to list at 750 or 800. We came in like 2 years ago with a massive discount. They told us that we will come out with an IPO by 2024-25. And we said, if your IPO price is going to be 450 rupees, I will work backwards and determine what is the price that I want to pay today. So if I'm sitting in 2022, an IPO is going to happen in 24, I will work backwards with a certain IRR, let's say 30-35% IRR, and then pay the price while going in. So the flexibility of being able to determine the price is a very big lever which a private equity fund manager has and a public fund managers, they don't have. Right? And like I mentioned, most of the times, by the time the company comes out with a public issuance, a lot of value creation has already happened. I'll talk a couple of examples of that, but it simply is a fact that most of the private equity investors, they bring the company to IPO for exit. So they have already, I would say, extracted the juice, and the remaining 10, 20 or 30% pop is left for the